Hi, this is Shubham from Monist and today in this podcast we will discuss various debt and equity investment products for Section 80C deduction under Income Tax Code 1961 for an assessee, individual or HUF. Here in this podcast we will discuss different instruments with in-depth analysis and what are the benefits available and who can get the benefit. If you want to read the full article, then the link of article is available in description. So let's start one by one. So what is the need of these options available? Tax management is an important key to take benefit of a tax exemption provided under Income Tax Act 1961. For this, we need to understand various debt and equity investment options available with us. Here the objective is to understand what is the main reason of the introduction and how we can get the benefit. Here we will discuss various debt instruments both in terms of a debt as well as equity investment option where we can get the benefit. So let's discuss various options available. The first instrument is Employee Provident Fund (EPF). The Employee Provident Fund, that is EPF, is a retirement benefit scheme in which employees of an organization contribute a small portion of their basic pay monthly. In the same line, the employer also contribute a similar amount on their behalf towards the scheme. Every employee is allotted a unique universal account number, that is UAN, by the Employee Provident Fund organization, that is EPFO. The employee EPF account is linked with this UAN, which is valid throughout the employee's life. Under the Employee Provident Fund Act, all organizations with more than 20 employees are required to register with Employee Provident Fund organization. Where an individual starts working in an establishment with more than 20 employees, both the individual, that is employee, and the employer are required to contribute at least 12% of their basic pay to an Employee Provident Fund account. Employee Provident Fund is eligible deduction under Section 80C of the Income Tax Act 1960 with maximum limit of Rs 1,50,000. Current interest rate, that is Q3 of financial year 2021 and 22, the rate of interest is 8.5% per annum. With a lock-in period is a retirement age, that is currently 58 as of now. In addition to this, also premature withdrawal is possible after 5 years subject to certain conditions. Let's discuss the second option available, that is VRS, Voluntary Provident Fund. VRS is a voluntary fund contribution from the employee towards the Provident Fund account. This contribution is beyond the 12% contribution which employee made in his Employee Provident Fund account. Maximum contribution is 100% of a basic salary and dearness allowance. A voluntary provident fund is an extension of a employee provident fund and the option available only to a salaried individual who receive a monthly payment through a specific salary account. The deduction amount available is same as Rs 1,50,000. The current interest rate, that is Q3 of a financial year 2021-22, is 8.5% per annum. With lock-in period is retirement age, that is 58 years. Also premature withdrawal is the same as Employee Provident Fund with basic requirements. The third option available with us is a Public Provident Fund (PPF). Public Provident Fund was established in India in 1968 with an objective to mobilize a small saving in the form of investment coupled with return on it. It can also be called as a saving cum tax saving investment vehicle that enable one to build a retirement corpus while saving on annual taxes. Public Provident Fund is a scheme in a long-term investment option that offers an attractive interest rate and returns on the amount invested. The interest earned and the returns are not taxable under income tax. Public Provident Fund is available for deduction in 80C. Maximum limit is 1,50,000. Current interest rate for Q3 financial year 2021-22 is 7.1% per annum with a lock-in period is 15 years as of now. It can be extended for another 5 years. Also premature withdrawal is available after 6th year subject to certain conditions. The fourth investment option available with us is Senior Citizen Saving Scheme. The Senior Citizen Saving Scheme is primarily for the senior citizens of India. Here the assessee should be more than 60 years of age and he should be a resident of India. The scheme offers a regular stream of income with the highest safety and a tax saving benefit. It is a government-backed retirement benefit program. Senior citizen resident in India can invest lump sum amount in this scheme individually or jointly and get access to a regular income through tax benefit. Employee Provident Fund is eligible deduction under Section 18C. Also, senior citizen savings scheme. The maximum limit is rupees 1,50,000. Current interest rate, that is quarter 3 of financial year 2021-22, is 7.4%. The fifth investment option available with us is Sukanya Samriddhi Yojana. As a part of a Beti Bachao Beti Padhao campaign, Prime Minister Mr. Narendra Modi launched a scheme called Sukanya Samriddhi Yojana. The campaign literally translates into Girl Child Prosperity Scheme in line with the above objective. Any girl child who is a resident in India, where a girl child who has not attained the age of 10 years from the time of an opening an account can open a Sukanya Samriddhi Yojana account in any post office or authorized branch commercial bank. Minimum rupees 150 and maximum rupees 1,50,000 in every financial year can be made an investment up to 15 years. The current interest rate, that is quarter 3 of financial year 2021-22, is 7.6% per annum. The sixth investment option available with us is a tax saving fixed deposits 5-year FD scheme. One can claim an income tax deduction by investing money in 5-year FD scheme under Section 80C of Income Tax Act 1961. The feature, benefit and terms associated with this type of account may not be a completely same as the normal FD accounts. RBI has announced a new rule applicable to unclaimed mature FD accounts. That is, the funds in unclaimed and mature FD account will attract an interest rate applicable to the saving account or the contracted rate of a mature FD, whichever is lower. 80's deduction available limit is rupees 1,50,000 and the current interest rate, that is quarter 3 of financial year 2021-22, is range between 5.5% to 7.5% based on the commercial bank, but the lock-in period is minimum 5 years. The seventh option available with us is a National Savings Certificate (NSC). The National Savings Certificate (NSC) is a fixed income investment scheme that you can open with any post office branch. The scheme is the Government of India initiative. It is a saving bond that encourages subscriber, mainly a small to mid-income investor, to invest while saving on income tax. You can invest in this scheme as low as rupees 1,000 or multiple of rupees 100 above that at initial investment and increase gradually. Current interest rate, that is quarter 3 of financial year 2021-22, is a 6.8% per annum to 7.5% per annum, where the lock-in period is minimum 5 years. Bank and NBFC accept NSC as a collateral or a security while considering secured loan. The next investment option available with us is an equity linked savings scheme, that is ELSS. An equity linked savings scheme or an ELSS fund is the only kind of a mutual fund eligible for a tax deduction under Section 80C of Income Tax 1961. You can claim tax rebate up to rupees 1,50,000, which is effectively translated into rupees 46,800 tax benefit. ELSS fund come with a lock-in period of 3 years and there is no provision to make a premature exit. You need to have an investment horizon for longer than 5 years to consider investing in ELSS. The equity exposure of ELSS fund requires you to do a longer investment horizon in order to mitigate the market volatility. Investing via SIP is advisable if you are not willing to take a higher risk. When you invest through SIP, you get an opportunity to invest in a fund across a business cycle. The next investment option available with us is Unit Linked Insurance Plan, that is ULIP. Unit Linked Insurance Plan is a mix of insurance along with investment. From a ULIP, the goal is to provide a wealth creation along with a life cover, where the insurance company put portion of your investment towards a life insurance and rest into a fund that is based on an equity or a debt or a both and matches the long-term goal. Unit Linked Insurance Plan, you will get a life cover coupled with investment. It offers security that a taxpayer family can fall back on in case of an emergency like death of a taxpayer or any inability or a hazardous event. ULIPs have a lock-in period of 5 years. If a ULIP is a surrender in the first 3 years, the insurance covered would ceases immediately. However, the surrender value can be paid only after 3 years. The next option available with us is a National Pension Scheme (NPS). The National Pension Scheme is a social security initiative by the central government This pension program is open to employees from the public, private and even unorganized sector except those from the armed forces. This scheme has been effective for a decade and so far has delivered 8 to 9% annualized return. In national pension scheme, you can also allow the option to change your fund manager if you are not happy with performance of a fund. Currently, there is a cap in the range of 75 to 50% on equity exposure for national pension scheme. For government employee, this cap is 50%. In the range prescribed, an equity portion will reduce by 2.5% each year, beginning from the year in which investor turn 50 years of age. So let's discuss the what is the bottom line. These all investment which we discuss are eligible for deduction in ATC of income tax at 1960 with maximum of rupees 1,50,000. All investment products are unique in nature and one should select investment product based on a personal financial journey, also a risk appetite. Thank you for joining with us. If you want to read the full article, then the link of the article is in the description. Thank you. Here Shubham from Monist signing off.